Welcome back. We will be covering Chapter 2, which is Analyzing Business Transactions. The concepts of this chapter is the foundation to what you will be learning throughout the semester, so it is very important that you take your time to learn the concepts in order to build a strong foundation. Your Chapter 2 focused on two sections. This lecture will focus on the second part of the chapter, because this is where the accounting equation is covered and it's what will be essential for you to complete your assignments. We are going to be using the basic accounting equation in this chapter. This is the foundation to the accounting principles in this course. The basic accounting equation along with the expanded accounting equation are going to become your best friends. So the basic accounting equation is assets equals liabilities plus owner's equity. And I will cover the expanded equation in a few slides from now. The basic elements of a business is what it owns and what it owes. Assets is what a business owns. So for example, let's say you are the owner of a restaurant. Your assets will be the chairs, the tables, perhaps a truck used for deliveries or to buy supplies, the cash register, the decorations, etc., etc. Liabilities and owner's equity are the claims or rights against these resources. So liabilities are claims to whom the company owes money to. So going back to the restaurant example, let's say you want to buy supplies for your business and you pay with a credit card or a line of credit. This means that you purchase the supplies on credit. This is a liability because your business or you as a business owner owes the money to someone else. In this case, you owe the money to the vendor that gave you the credit. Owner's equity, on the other hand, are claims of owners. So to distinguish the difference between liabilities and owner's equity, let's pretend that you have been in business for a long time and you have decided to retire. And you're going to retire by closing your restaurant. So you will not be going to offer it to someone else or sell it. The assets is what you own in your business. So the furniture, the decorations, the kitchen equipment, all of that is what you own. Those assets is what you own before you close the business. But before you close your business, you have to clear the debt of your business. So you may owe money to your credit line, you may owe payroll to your employees, you may still owe payments to your truck or any equipment that the business owns. So these are your liabilities that must be cleared before you close your business. Once that is taken care of, whatever is left belongs to you as a business owner. This is owner's equity. If at any time you want to know how much your business is worth, what you can do is subtract the assets minus the liabilities in order to determine that value. Let's focus our attention to owner's equity. Owner's equity can increase or decrease during the life of your business. Whether it increases or decreases will depend on the business financial health. The health of your business will depend on several components, which include the size of your investment, which is owner's capital, the amount you pay yourself as your income, or the amount of money that you withdraw from your business for personal use, that is owner's drawings, the amount that you pay, the level of sales within your business, which is revenues, and the level of expenses to run the operations of your business, which is expenses. This is where the expanded accounting equation comes into play. This slide shows you both equations and the abbreviations that I like to use to make it easier to read and to memorize, and also to fit into the PowerPoint slides. So the accounting equation is assets equals liabilities plus owner's equity, and it's abbreviated by using the first letters of each equation component. So in this case, it's A equals L plus OE. We also have the expanded accounting equation, and the extra components of the accounting equation comes from owner's equity. Notice the parts of the equation that are in the color red. The level of owner's equity will depend on the financial health of your business, which consists of the components of the expanded accounting equation that are in the color red. This includes the amount invested by the owner, known as owner's capital, the payment levels to the business owner as income or money withdrawn from the business for personal use, that is known as owner's drawings, the level of sales, known as revenues, and the amount of expenses to run the operations of the business, known as expenses. So the expanded equation is expanded in the area of owner's equity. Owner's equity is equal to owner's capital minus owner's drawings plus revenues minus expenses. So if we substitute this information under owner's equity, our expanded accounting equation becomes assets equals liabilities plus owner's capital minus owner's drawings plus revenue minus expenses. And the abbreviated equation is here below. What I'm going to do is give you additional information within each of the components of the accounting equation, and I will continue to use the example of being a restaurant owner in order to give you a perspective to the concepts. Assets are the resources that a business owns. This includes property, equipment, and revenue. So in the restaurant case, this includes the tables, the chairs, refrigerators, the cash register, stands or displays, and of course, your cash. Within assets, we will be dealing with different accounts to record accounting transactions, and these are here below. These accounts include the cash account. All transactions that deal with cash money coming in or out of the business will be recorded under the cash account. For accounts receivable, all transactions that deal with money that is owed by a customer to the business will be recorded under the accounts receivable. To give you the most common example is when you sell something to your customers and they pay you with a credit card. At the moment of the transaction, the customer does not pay you with cash that you can record in the cash account. You receive the credit card as form of payment, but you don't physically receive the cash until you process the credit card payments with the credit card company. So in the meantime, while you wait for the cash to be sent to you, you will record all credit payments in the accounts receivable account. Once you receive the cash, then you record another transaction to reduce the amount owed to you in accounts receivable, and then you increase your cash account. Another account is equipment. This is where transactions are recorded when equipment is purchased, like the chairs and the tables. And the last account that I will be introducing you is the supplies account. This is where all transactions are recorded when supplies purchases are made. So for example, for our restaurant example, this can include food ingredients or containers, cups, napkins, pencils, paper, etc., etc. Liabilities are claims against the assets or the debt and obligations. As stated earlier, you may buy different items from your business on credit. It doesn't matter what it is. Equipment, supplies, doesn't matter. When you owe money for something that you purchased, it becomes a liability. Within liabilities, we will be dealing with several accounts as well. This includes the accounts payable. When you buy something and you buy them on credit, you end up being in debt with someone, in this case the vendor that gave you the credit. So to record these types of transactions, we will be recording them in accounts payable. Think of accounts payable as credit lines. You are giving credit by someone up to a certain amount. So you may charge a few dollars here and there, or like your credit cards, you have a limit and you use the credit cards as often as you like, as long as you don't exceed that limit. We also have notes payable. Notes payable, on the other hand, it is still money that you owe, but think of notes payable as an example when you buy a vehicle. The dealer approves, or the bank approves you for credit to buy the vehicle for the exact amount that the vehicle is worth, or the price of the vehicle. Nothing more, nothing less. So this is a note that is negotiated that states that you owe the amount of the vehicle and you have agreed to pay it back on a monthly basis for a number of years. So when you buy something similar to this example, you will record the transaction in notes payable. And the last account is salaries and wages payable. As a business owner, you will most likely have employees working on the operational aspects of the business. So you may pay employees once a month, but every day that these employees work, they are accumulating salaries and wages that you owe to them until you cut a check. So in the meantime, while you process payment, you will record these salaries and wages in the salaries and wages payable. Now, remember that owner's equity is residual equity. I gave you the example about a business owner closing the business due to retirement, and I explained how all liabilities need to be paid in order to determine the level of owner's equity. So this is the ownership claim on total assets. The accounts that are under owner's equity match the components of the expanded accounting equation that I introduced to you earlier. Every time there is an investment of cash into your business, it will be recorded in owner's capital. When the owner withdraws cash for personal use, it could be the salary or for whatever reason, we record the transaction in owner's drawings account. And when there's a sale, whether it's a sale for a service or because you sold a good, we record the revenues in the revenues account. And then when we have expenses that need to be paid, like rent or utilities, we record the expenses in the expense account. Depending on the activities that occur within your business, each account that I previously explained will either increase or decrease. Depending on the change, whether it increases or decreases, the overall owner's equity levels will also increase or decrease. In this case, owner's equity will increase when the owner invests in the business, and then when revenues increase. On the other hand, owner's equity can also decrease, and it decreases when the owner withdraws cash or assets for personal use, and when expenses must be paid. So these are the components of the basic accounting equation and the expanded accounting equation. We are going to be working with these two equations to begin identifying and recording transactions. So let's go into that. Let's look at some possible events that will require the identification and recording of transactions. And we will begin with the notion of opening your own restaurant business. So let's say you have saved money for some time and now you have $30,000 in cash that you want to invest in this new business. This event is in monetary form since we are dealing with money. So we have to record it. Anytime we have any event that deals with money, we have to record it as an accounting transaction. So when you record the transaction, you have to impact at least two accounts within the accounting equation. It doesn't matter which equation, whether it's the basic or the expanded equation. You have to impact at least two of the accounts, and the equation must balance after each recorded transaction. In other words, you are going to know if you did something wrong in your homework assignments if assets does not equal liabilities and plus owner's equity. So here's transaction number one. Owner invests $30,000 in a restaurant business. You are going to ask yourself the following questions when you need to record a transaction. Ask yourself the first question, which is, which component of the accounting equation is affected by this event? So to answer this, you need to determine whether investing money is an asset, a liability, or part of owner's equity. Well, in this case, we're dealing with cash, which is an asset. So now that you've determined that it's an asset, you ask yourself the next question. Which account within the accounting equation component, in this case it's assets, should the transaction be recorded? If you refer back to slide 5 of this presentation, you are going to see the possible accounts that are within assets. I explain each one of them. This includes the cash account, the accounts receivable account, the equipment account, or the supplies account. Well, in this example, the owner is investing $30,000 in cash. The owner is not investing it in $30,000 worth of supplies or equipment. So the transaction needs to be recorded under assets in the cash account. And then the last question that you need to be asking yourself is, will investing cash increase or decrease the cash account? Well, this is an investment into the cash account, so the cash account will need to increase. You're depositing money into the cash account. Therefore, we will record this under the cash account within the asset component of the accounting equation as a positive $30,000. In your homework assignment, I don't think you have to put the plus, but you do have to put the minus when it's a minus. So those are the questions that you ask yourself to determine which account is affected. But as I said earlier, you have to affect at least two accounts. So ask yourself the questions again. This time ask yourself, is there another component that this event affects within the accounting equation? To answer this question, the owner is investing cash into a business, so when there is cash coming into the business, owner's equity is going to increase. So if you look back at slide number 8 of this presentation, owner's equity increases when there are investments by the owner. So now you know that it's owner's equity. So ask yourself the next question. Which account within the accounting equation component, in this case is owner's equity, should the transaction be recorded? So to answer this question, refer back to slide number 7. Remember that the accounts within owner's equity is owner's capital, owner's drawings, revenues, and expenses. Well, this is an investment, so this transaction will be recorded under owner's capital. So you know that it's within owner's equity and you have to record it in the owner's capital account. So now you need to know the last answer to the question. Will this transaction increase or decrease the owner's capital account? Well, this is an investment and it's going to increase the owner's capital, so the transaction will be recorded under the owner's capital within the owner's equity accounting equation as a positive $30,000. And remember that here we just put it as positive for me to explain to you the concept, but I am 100% sure that in your homework you don't put the positive. If it's positive, you just put the amount, but if it's negative, you do put the minus. So the last question, you've impacted at least 2 equations. In this transaction, it only impacts 2 equations. So the last thing that you need to ask yourself is the equation balanced? So what you need to do is you need to add each account that is affected by the recording of the transaction. Okay? In this case, we started with $0 in the cash account. And the owner invested $30,000, so the amount in the cash account is now $30,000. And that's recorded in color red. Liabilities is left alone because nothing happened there. But in owner's capital account, we also started with a zero balance, $0. And because of the investment, the owner's capital account is now, it now has $30,000. And that's also recorded in red. So as you can see, our accounting equation is balanced because assets equals 30,000 and liabilities plus owner's equity also equals 30,000. So 30,000 equals 30,000, that means it's balanced. And that's it. I have shown you how to record a transaction, your first transaction. And you're going to be taking similar steps. It will be required for you to take the similar steps for you to follow and continue with the recording process. So here is transaction number 2. Now, you have invested and recorded $30,000 for your restaurant business. And so next, you decide to buy equipment. Perhaps you want to buy kitchen equipment. And you're going to buy it in the amount of $10,000. You are going to continue to ask yourself the same questions that I asked in the previous example. So the first one is, which component of the accounting equation is affected by this event? So to answer this, you need to determine whether investing the equipment is an asset, a liability, or if it's part of owner's equity. And we are dealing with equipment, so this is also an asset. So now that you know that it's an asset, you need to ask yourself, which account within the accounting equation component, in this case assets, should the transaction be recorded? Again, refer back to slide number 5 of this presentation so you can see the possible accounts that are within assets. Remember that this includes cash, accounts receivable, equipment, and supplies. And the key word here is equipment. The owner is buying equipment for $10,000 in cash. The owner is not buying supplies. So the transaction needs to be recorded under assets in the equipment account. So the next question is, so will buying equipment increase or decrease the equipment account? Well, this is an investment in the form of equipment, so the equipment account will increase. Therefore, we're going to record this under the equipment account within the asset component of the accounting equation as a positive 10,000, which is right here. So, next question. Is there another component that this event affects within the accounting equation? Well, to answer this equation, the owner is buying equipment with cash. You're going to say, well, I don't see cash here in the transaction details. Well, you know it's cash because it is either directly implied in the event information or otherwise the form of payment is identified as credit if it's not cash. Well, in this case, it doesn't say credit, so we know that this is purchased with cash. So it affects this account because the owner must pay for the equipment with cash, and you know that cash is part of the assets component of the accounting equation. Okay? So now, which account within the accounting equation component, in this case assets, should the transaction be recorded? Well, as just stated, the cash account will be affected, so we will have to record this transaction in the cash account. And then the last question is, will the transaction increase or decrease the cash account? Well, in this case, the owner must make a payment. It's not investing, it's making a payment. And it's using the cash account to make that payment. So the account will have to be decreased. So therefore, we are going to record this as minus 10,000 in the cash account. And remember that in your homework assignment, you do have to log it in as minus. Now, in this case, it only affects two accounts. So the last question is the accounting equation balanced? So again, what you need to do is add each account that has been affected and also bring down the balance for the accounts that are not affected by this event. Notice that we still have the information from transaction number 1 in this slide. Our cash account started with a balance of 30,000. And we must subtract 10,000 in order to pay for the equipment that was purchased with cash. So now our new balance in the cash account is 20,000 and it's in red. In our equipment account, it started at 0 and we purchased $10,000 worth of equipment. So now we have $10,000 in the account. Nothing happened in liability, so leave it alone. And for owner's equity, even though it wasn't affected by this transaction, we still need to bring down the balance of the account. So it started with $30,000 and nothing went in or out of the account, so it still remains at $30,000, which is in red. And then you're going to add them to make sure that the equation is balanced. In assets, we have two accounts now that are in assets, so we got to add these two. 20,000 plus 10,000 equals 30,000. There's nothing in liabilities, and in owner's equity, there's another 30,000. And we're gonna know if it's balanced when we verify that assets equals liabilities plus owner's equity, and it does. It is balanced because in this case, the values are in blue, and 30,000 equals 30,000. And you have recorded the transaction for this event. That's it. We're going to continue with this process when we record transactions for a particular business. So note that this slide has even more information. It's expanding, but we still leave the previous information untouched. Eventually, this table is going to be too large. While it's an effective way to keep track of the transactions because of the size that it can turn out to be, it's not always an efficient way to record accounting transactions. This is why this is only the foundation of accounting. It gives you a perspective on the accounting process, but later in the chapters you will learn more efficient ways to keep the recording process going. So let's just continue for now, since this is what you have to learn for this chapter. Let's continue with the next transaction. And the next transaction is the owner buys supplies on credit for $5,000. Ask yourself a question again. Which component of the accounting equation is affected by this event? Well, supplies is an account in the assets account. So supplies is part of the assets component of the accounting equation. And so now that you know it's in the assets accounting equation, ask yourself the next question. Which account within the accounting equation component, in this case assets, should the transaction be recorded? The answer is a little more straightforward in this case because the key word here is supplies. I hope you are starting to see the pattern here. The transaction information or the event will mention keywords that will help you determine which account it affects. In this case, it affects the supplies account. And now ask yourself the next question. Will buying supplies increase or decrease the supplies account? This is an investment into the supplies account. So the supplies account will increase. Therefore, we will record this under the supplies account within the asset component of the accounting equation as a positive $5,000. So the next question that you need to ask yourself, is there another component that this event affects within the accounting equation? Well, to answer this question, the owner is buying supplies on credit. Credit is another key word here. The supplies are not being paid with cash, so the owner still owes $5,000 to someone, in this case the vendor who gave the credit. So this is a liability. So which account within the accounting equation component, in this case liabilities, should the transaction be recorded? So to answer this question, go back to slide number 6 that talks about liabilities. And it shows you the different accounts. Remember that the accounts within liabilities are accounts payable, notes payable, and salaries and wages payable. The owner is buying this on credit, so treat it like a credit card. Therefore, we are going to record this under accounts payable within the liabilities component of the accounting equation, okay? And then you're going to ask yourself, will the transaction increase or decrease liabilities? Well, you're adding credit that you owe to the vendor, so this will increase your liabilities, and it has to be recorded as a positive $5,000 under the accounts payable within the liabilities component of the accounting equation, okay? And then the last question you need to ask yourself is the equation balanced? So then again, you add each account that is affected by the recording process of the transaction. So in supplies, we started with $0, and then we purchased $5,000 in supplies. So the total amount of the supplies account is now $5,000, which is in red. And likewise, accounts payable, it started with $0, and because of the purchase on credit, the accounts payable account is now $5,000, and we bring it down in red. And then we bring down the balances of those accounts that were not affected with this event, and we make sure that the equation balances. So we bring down what was in the cash account, which is 20,000, the equipment, which is 10,000, and owner's capital, which is 30. And then we make sure that we add all of this, paying attention to the accounting equation, and we verify that in fact it balances because 35,000 equals 35,000 in blue. So moving onto the transaction 4, the owner makes sales for $1,000 in cash. I'm not going to go through each of the questions now. Now I'm really going to explain to you the bulk of how you should be evaluating these events and how you should be identifying which accounts are being affected. So the owner makes sales for $1,000 in cash. Notice that the keywords here are sales and cash. Sales in this case is revenues. And revenues is part of owner's equity. And when they are in cash, so we're receiving the sales, we're receiving money, cash right away, we record the transaction under the cash account under assets. The money is coming into the business, so we add this as a plus $1,000 in the cash account. And then we also add it into our revenues account as a positive $1,000 to record that we have sold $1,000 worth of services or goods. So then we add all of the accounts, no matter if they were affected by the event or not, and then we make sure that the equation is balanced. So the balances of each account is in red, and then we make sure that the accounting equation is balanced, and in this case it is. Is 36,000 equals 36,000. Transaction number 5. Owner purchases marketing for $500 on credit. The keywords here are marketing and credit. Marketing is an expense. It's not an asset. It has no value. It doesn't add value to your business, to your net worth. So, and expenses are recorded under owner's equity. And the other keyword here is credit. It was purchased on credit, which means that it was not paid with cash, so the owner still owes this money to the vendor that provided the credit. So this goes under accounts payable, which is under liabilities. So we record that as a positive $500. So what we do is we add $500 as a positive under accounts payable and under expenses. And then we go back to our routine. We add each balance on each of the accounts, which are in red. And then we make sure that the equation is balanced. I want to pay or direct your attention to the expanded accounting equation. Here's the expanded accounting equation. It's cash plus supplies plus equipment equals accounts payable plus owner's capital minus plus revenues minus expenses. Please note that pay attention to whether it's going to be adding or subtracting here, okay? Because we have added everything here as positive except when we pay for cash, but we need to make sure that at the end of it all, when we come to minus expenses, we record the balance as minus 500. And if you do that, when you add all of this stuff here, you're gonna see that the accounting equation balances, and it's because it's 36,000 equals $36,000. So, transaction number 6. The owner makes sales for $1,000, and out of that $1,000, $500 was in cash and $500 was on credit. Here we have 3 key words: sales, cash, and credit. And since we have 3 keywords, guess what? We're going to have 3 accounts that are affected by this. Sales are revenues. The total revenue of this transaction is $1,000. So we record the entire $1,000 as a positive under the revenues account. Now, $500 of the revenue was received in cash. So we record this as a positive under the cash account right here. And the remaining $500 goes under accounts receivable. Remember that we record any money that is still owed to the business in accounts receivable. And then we add the balances on each of the accounts, which are the values in red. And then we make sure that the accounting equation balances. Transaction number 7. Owner makes rent expense payments for $2,000 in cash. The key words here are expense and cash. Expenses are recorded under the expense account. So we record the expense as a positive $2,000. And the expense was paid in cash, so we have to report this under the cash account as a minus, because in this case we are going to take out money from the cash account to make the payment. So then we add all of the account balances, and then we make sure that the equation balances. Okay? Transaction number 8. Owner makes payment for $3,000 in cash for credit purchases. The key words here are cash and credit. The owner, in this case, wants to pay off some of the debt that has been incurred because of the credit purchases that were done earlier. So remember that any credit purchases are recorded under the accounts payable. Okay? This account currently has a balance of $5,000, right? It has it's actually $5,500. And the owner wants to pay off $3,000 out of that $5,500 that it owes. So we record this under accounts payable as minus $3,000. Minus $3,000. And the payment was done with cash, so we record this under the cash account as a minus as well, because we're taking out money from the account to pay off the debt. Okay? So the payment was done with cash, so we record this under the cash account as a minus $3,000. And then we add all of the account balances, and we record them in the red, right here in the color red. And then we make sure that the equation is balanced, and it's shown that it's balanced in blue. Our last transaction is number 9. The owner withdraws $2,000 in cash for personal use. The key words here is withdraws in cash. Anytime the owner withdraws money or cash for personal use, we record this under owner's drawings. So we record this as a minus $2,000. Okay? And we don't do that here because remember that the equation is capital, owner's capital minus owner's drawing. So if we put another minus here, you remember your algebra, a minus and a minus equals a positive. We don't want to do that. So we want to make sure that we leave it positive here as 2,000 because the accounting equation will take care of subtracting this, okay? So that withdrawal was done in cash, so we record that as a minus under the cash account as $2,000. And then we add all of the accounts to make sure that we get the balance for each one, which is in red. And then we make sure that the equation is balanced. Notice that after all of these transactions that I just presented to you, we have the representation of the expanded accounting equation. It's here, plus the other accounts that are within assets. So this slide summarizes the accounts that were affected based on the scenarios. So when the owner invests cash in the business, you record it as a positive in cash and an owner's capital. When items are paid in cash for expenses, the cash and the expense accounts are affected, and it'll tell you whether it's a positive or a negative. And the purchase of equipment, which is paid in cash, it tells you that the cash and the equipment accounts are affected, and it tells you whether it's in positive or negative. And this slide it continues with the same information, but with other scenarios. It continues to summarize the accounts affected by the different events. So if there's a gain, if you gain a cost on an account, then it affects the accounts payable and expenses. If you provided a service or you sold goods but only received partial payment in cash and the rest in account, then it affects the cash, the accounts payable, and the revenues. And lastly, if you withdraw cash for personal use, then it affects the cash and the owner's drawings accounts. Once you record the transactions, reports need to be completed to summarize the financial data. And we call these reports financial statements. In this case, we have 4 that we will cover, including the income statement, which is a formal report that covers specific information in relation to income and expenses. Essentially, the income statement determines if there's a profit or a loss at a specific period of time. And the owner's equity statement provides information about the net worth of the business. The balance sheet is a formal report that includes the assets, the liabilities, and owner's equity on a specific date. And the statement of the cash flows is a report of the cash that comes in and out of the business. So this concludes the lecture for this chapter. For our next lecture, I will cover more in depth about the financial statements. For now, I need you to focus on knowing how to identify which accounts are affected based on a specific scenario. So please make sure that you read the chapter and that you complete your homework assignments and you review this lecture very carefully. And if you have any questions, please let me know, okay? And that is all for today. Thank you for your valuable time.